The real question, the reason you clicked on this video, is what do you buy right now that hasn't already run? I found 3 of them, all trading under 20 bucks a share. 3 companies the big money hasn't fully woken up to yet. And one of them is sitting on a catalyst so big that when it finally hits, people are going to wish they bought it at $17. I'm breaking down all 3 today. The numbers, the story, the risks, and what you should actually do with this information. Before we dive in, if you're serious about finding real opportunities before they become obvious, subscribe right now and hit that bell. We do this every single week. Real analysis, no fluff, no hype. You don't want to miss what's coming. Here's the lineup. A Brazilian fintech the market keeps undervaluing. A European legacy tech company making a very quiet comeback. And a US fintech whose numbers are moving in all the right directions, except one. That one detail is important and we're going to get into it. Let's go. Stock number 1. And I want you to hold your first reaction here because your first reaction is probably wrong. Nu Holdings, ticker NU, parent company of Nubank. It's Brazilian. It's a fintech. It's trading at $17 a share. I know what you're thinking. Emerging market, currency risk, pass, stop. That framing is literally costing you money. Nubank is not some scrappy startup trying to figure out a business model. They are the largest digital bank in Latin America. Over 100 million customers. More customers than the majority of US banks. Think about that for a second. 100 million people chose this platform over traditional banking. Not because they had to, because it's genuinely better. And they're growing at a pace that would make Silicon Valley blush. At $17 a share, Nu Holdings is trading at a compelling price-to-earnings multiple, cheap relative to where they're growing. Their customer base is expanding faster than peer fintechs. Revenue growth has been accelerating. Profit margins are improving quarter over quarter. They're not burning cash trying to find a business model. They have one. It works. And the market is pricing them like they don't. That's a mispricing. And mispricing's correct. But here's where it gets genuinely exciting. Nu Holdings is not satisfied being the dominant bank in Brazil and Mexico. They have set their sights on the United States. Think about what that actually means. They have over a decade of experience building the most customer-friendly digital banking experience in the world. They know exactly what makes traditional banking painful. The fees, the friction, the hidden charges, the hold times. And they have systematically eliminated all of it. If they bring that product to the US market, even capturing a small fraction of it, the addressable opportunity is massive. There are over 330 million people in this country. Millions of them are underbanked, underserved, and actively looking for something better. This isn't a question of whether they can build a great product. They already have one. The question is execution in a new market. And that's the risk I want to be straight with you about. US banking regulation is a completely different beast. Licensing, capital requirements, compliance. It is not a copy-paste from Brazil. This expansion is not going to happen next quarter. If you're buying Nu Holdings looking for a quick pop, you might be disappointed. This is patient money. You're buying the company at $17 before the US story becomes obvious to everybody else. At this valuation, the downside feels limited. The upside, if the US expansion even partially works, is substantial. This one goes on the buy list. Scale in, don't bet the house, but don't ignore it either. Drop a comment below. Are you already watching Nu Holdings? Are you in, or are you skeptical? Tell me why. I want to know. Now let's shift gears completely. From a 100 million customer digital bank to a company most people under 40 associate with a phone their parents owned. Stick with me. Stock number 2. Nokia, ticker NOK. Yes. That Nokia. I already know some of you just rolled your eyes. Don't. Because that reaction, that automatic dismissal, is exactly why this stock keeps getting overlooked. Nokia today is not the Nokia that lost the smartphone wars. That chapter is completely closed. Nokia today is a global telecommunications infrastructure company. They build the 5G networks that every smartphone in the world runs on. They hold patents that competitors literally have to pay royalties to use. They work with governments, defense agencies, and the biggest telecom operators on the planet. This is not your grandfather's phone company. This is a picks and shovels infrastructure business sitting right in the middle of the global 5G build-out. And here's what the discounted cash flow analysis from Investing Pro tells us. Nokia is undervalued, meaningfully. The market is pricing this company at a discount to what the underlying cash flows actually justify. That gap is the opportunity. And while you wait for that gap to close, Nokia is growing their income, quarter after quarter, and they're raising their dividend. Let me say that again. They are raising their dividend. In an environment where companies are cutting dividends, hoarding cash, or diluting shareholders just to stay alive. Nokia is returning more money to investors. That's a confidence signal from management. They believe in the direction of this business. Dividend growth attracts income investors. It puts upward pressure on the stock. It changes the narrative around a company. Now, I'll be honest with you. Nokia does not move fast. This is not a stock that doubles in 6 months. Telecom infrastructure is slow-moving by nature. Contracts are large, but they take time to sign, deliver, and recognize as revenue. There's also ongoing competition in certain regions, and Nokia has been in restructuring mode, which is the right move, but restructuring is never painless. This is not a momentum trade. This is a value play with income attached. If you're looking for a stock that's undervalued by the cash flow math, pays and grows a dividend, and sits in the infrastructure layer of a global 5G build-out, Nokia fits that description. Buy Nokia, collect the dividend, and wait for the market to close the valuation gap. That's the play. If this breakdown is adding value to your investing, hit that like button right now. It helps this content reach more people who are serious about this stuff. I appreciate it. All right, 2 down, 1 to go, and I'll be straight with you. Number 3 is the most interesting of the bunch, because it's not perfectly clean. There's something in the numbers that's keeping it off a lot of people's radar. But when you look at the full picture, I think you're going to understand exactly why it belongs on this list. Stock number 3, SoFi Technologies, ticker SOFI. If you're not familiar, SoFi started as a student loan refinancing company. It has become something much bigger. It's now a full-stack digital financial services platform. Banking, investing, lending, credit cards, financial planning. They built their own technology infrastructure layer called Galileo that other fintechs actually pay SoFi to use. They got a bank charter in 2022, which fundamentally changed what they're allowed to do and how profitable they can be. This is a real company. Real revenue, real customers, real growth. Here's what the data shows. 3 lines moving in the right direction at the same time. Price, up. The market is acknowledging something is happening here. Revenue, up. Growing, consistently. Members are joining, using multiple products, generating recurring revenue. Net income, up. They've crossed into profitability. This is no longer a when are they going to make money story. They're making money. Find me another fintech at this price point that can say all 3 of those things simultaneously. It's a very short list. Now here's where I have to be straight with you. Not everything in SoFi's picture is clean. The cash flow statement looks shaky. And when you pull up their Investing Pro financial health score, there's a drag. The price momentum component is pulling the overall score down. These are real observations. Not deal breakers, but not nothing. Cash flow in fintech can be genuinely lumpy. It doesn't always tell the same story as the income statement because of how loans and financial products sit on the balance sheet. But it's something you need to monitor. And price momentum being a headwind means the market hasn't fully committed to this being a buy yet. There's still skepticism out there, which honestly is part of why the opportunity exists in the first place. SoFi is a conviction play for investors who can handle some noise. The fundamental business is moving in the right direction across the metrics that matter most. The bank charter gives them advantages they didn't have 3 years ago. The Galileo tech layer is a revenue stream completely separate from their own lending business. Watch the cash flow trend over the next 2 quarters. If it stabilizes or improves, that headwind disappears, and the story gets a whole lot cleaner. For now, small position, watchful eyes, and a clear reason for why it belongs in the portfolio. Here's my question for you. Of these 3, New Holdings, Nokia, SoFi, which one fits your investing style the best? Drop it in the comments right now. I read all of them. All right, let's bring this all together. 3 stocks under $20. If I had to rank them right now for where I'd put my own money, New Holdings is my top conviction pick at this price. The growth is real. The U.S. expansion is a legitimate catalyst, and $17 feels like a genuine undervaluation. SoFi is number 2, with the caveat that the cash flow picture needs watching. Strong fundamentals, but not fully clean yet. Nokia is number 3 for the value investors who want income while they wait. Slower moving, but the discounted cash flow and the dividend tell a consistent, honest story. Here's the thing about stocks under $20. People dismiss them automatically. There's this psychological bias that equates a low share price with low quality. It's wrong. Share price is mostly arbitrary. What actually matters is valuation relative to fundamentals. What matters is the business underneath the ticker symbol. All three of these companies have real businesses, real customers, real revenue. They're just priced in a range that the crowd hasn't paid attention to yet. That's where the opportunity lives. Always has been. Quick note before I go. This is my analysis based on my own research. It is not financial advice. Your situation, your timeline, your risk tolerance, those are yours to figure out. Always do your own homework before you put a single dollar into anything. You can check out Investing Pro using the link in the description below to run your own analysis on any of these. There's a discount code down there too. 3 things before you go. First, if this video added value to your thinking today, smash that like button. 1 second of your time genuinely helps the channel reach more people who are serious about this. Second, subscribe and hit the notification bell. New analysis drops every week. You don't want to be the person who finds out about the opportunity after it's already moved. Third, leave a comment. Tell me which of these 3 stocks you're most interested in, or tell me why you think I'm wrong. I'm here for both. Next week, we're going deep on a sector I think is being completely mispriced by the market right now. You're going to want to be here for that one. Until then, stay patient, stay disciplined. The best time to find a great stock is before everyone else does. See you next week.